Hey guys, welcome back to the Fourth Point Wealth channel. Hope you're having a wonderful day. Thank you for tuning in. I want to take a little bit of a rewind today. I want to go back to basics, a little bit of finance and investing 101. Over the last couple of weeks, we've had tons of popularity in the online trading platforms. It's been all over the news with the Wall Street bets off of Reddit platform going after these short trades. GameStop, AMC is a couple of examples, and then Robinhood and some of these other platforms shutting down trading. That's been all over the news along with other fad issues, etc. But I want to get back to the basics. For those that maybe haven't ever been taught this, what is a stock, right? So there's all these different terms. Our industry loves to make things as confusing, complex, intimidating, and scary as they possibly can for a lot of reasons. One, because I think they like to hear themselves talk, but two, and more importantly, it's because we get confused as consumers and we place them with their complicated language up on a pedestal, and it makes you think that you need people like me. Our job here at Fourth Point Wealth is not to make you think you need us. It's more, how can we teach you, how can we empower you to take control of your money? And if you want our help, wonderful. Most of the language you see is just synonyms for some easier term, right? When they talk about leverage, that's just debt or borrowing. When they talk about equities, that's stock or ownership. We'll get through some of these things, and the list can go on and on and on the terminology that makes it just simpler to understand even to a first grader when we just use the right terms. But welcome to our industry and what it kind of does to us. Before we get started, go ahead and do me a favor. Please like and subscribe to the video. Make sure that you stay up to date on all of our content, and it pays homage to the YouTube algorithm and helps us out quite a bit. Okay, so step number one, I think it's important to say, why do stocks exist, right? Why are shares being traded all over the place? When a company is trying to raise money, right? They're growing and growing and growing, and now they need tons of capital. They need more money to be able to build out, whether it's infrastructure or new technology, hire more people, depending on the type of their business. They have a lot of different options that they can go to. A typical, if I was as an individual looking to get money for an investment of some sort or to grow a business, I might borrow it from the bank, or I might sell a portion of my business. That's exactly the same situation in what's called an IPO, an initial public offering. And these have been in the news for decades now, and everybody trying to chase after these tech IPOs is what they kind of call it, right? One of the most famous ones was several years back with Facebook. But when a company is growing and they need to get an infusion of money in order to encourage that growth and invest in it, they can either borrow money or they can sell stock in the company, right? So they may do that to private individuals with some early investors, but when you do this IPO, initial public offering, that's where suddenly all of these shares of the company, which are fractional bits of ownership in that company, are sold to the public, right? They're issued out and then everybody can trade them around. So next, where does the return come from? What's my risk and what am I trying to accomplish in a stock, right? They always say buy low, sell high. We'll talk later about whether or not you can time that, but I want to buy it for one price and I want to sell it for a profit. That's how you make money on a stock. Now there's other issues like dividends and stock splits and things that we can get into another time, but the basic level is, I think that a company is going to do a great job, or they're continuing to grow, or I think the market in general is going to grow. I'm going to buy in. I own a portion of that company, and thus as their profits grow, if they grow and do a good job, that company's worth more. And so now as my ownership has built in value and I can sell it for a profit. Now, I also bear the risk of, well, what if that company does a terrible job, and whether it's bad leadership or a bad product, if it's not the right pricing, bad market concerns, I also run the risk of the value of that stock going down or even all the way to zero. I could lose my investment. So it's important, obviously, to evaluate what your decisions are going through these, but people need to understand what a stock is. I own that company or whatever share that I have, and its value can either increase or decrease. There are a ton of different places and ways to get a hold of these shares and become an owner, right? So the most common is through either an advisor or some sort of an online trading platform, whether that's one of the big places like a Fidelity, a TD Ameritrade, a Charles Schwab, all of these different options that are out there. I can get them through most of my banks as well. They all have these kind of wealth management arms where you can open up an account and be able to trade some stocks within. And then in our more recent couple of years, the technology platforms or robo-advisors that are like a Betterment, a Wealthfront, a Robinhood that has been popularized obviously in the news of late. There's all these different ways, right? Versus going back to about the 80s when think of the images that we saw in school of the trading floor at the New York Stock Exchange and everybody screaming and yelling into two different phones, and not to be confused with the Wolf of Wall Street trading on the pink sheets. Those are not listed. There are these tiny little companies, right? That was a whole other world. Now, when these companies list or go IPO, go public, right, they're listed on the New York Stock Exchange or some public exchange. This is the platform where essentially the money changes hands and the ownership of the shares is recorded. There are brokers that typically will handle those transactions, whether it's a huge investment company like a Fidelity, a TD, Ameritrade, a Charles Schwab, all the way down to advisors being able to trade back and forth depending on the platform they're using. And more popularly now in the last couple of years is some of these online tech trading platforms like Robinhood that we've seen in the news the last couple of months and weeks. The important thing is to, one, look and see what are the transaction costs. What are they trading and charging you for? Is there a big bid-ask spread? What's the difference between the actual trade price and what I'm getting that trade for, whether I'm buying or selling? Going back to some of the terminology real quick, so when they talk about long versus short, and I think this is a really important thing to note when you're dealing with stocks, typical risk, right? When I buy a stock, that's the same thing as going long. Welcome back to our silly terminology. But long on a stock is I buy the stock and I expect it to go up. If I'm short on a stock, I expect it to go down. I'm selling. Short selling is what's been particularly in the news around the Wall Street Bets Reddit platform. They were trying to run up the price because hedge funds had shorted those couple of stocks, GameStop, AMC, and several others. What that does, and the risk is changing on these two different types of positions. When I go long on a stock, if I buy a stock, my risk is that that company either decreases significantly in value because they're not doing a great job, or what if they go out of business altogether? If they are bankrupt, boom, I go to zero on that stock. It's an eggs in one basket situation. Hopefully you're diversified across a lot of things. Now, if I decide to short sell a stock, it's totally different. My risk is different. In a short sale, what I'm actually doing is borrowing that stock and I'm selling it. Then I have to buy it back. I'm hoping that it basically drops in price so that I can then buy it back at a lower price, keep the profit, and I give that stock back to wherever I borrowed it from the brokerage. So the risk on my short sale is, what if that company just keeps doing better and better and better and better? That price keeps going up. Eventually, I have to buy that stock back. I have unlimited risk. There is no floor to what I could lose. On a long side, if I buy a stock, I can lose what I invested in it. On a short sale, there's no end in sight necessarily. I have to decide when I'm going to get out of that thing and just bite the bullet. That's what this Wall Street Bets platform has been doing. And they're trying to basically bankrupt some of these short positions because they felt like they could. But you got to understand the risk that you're getting into when you're buying stocks. It's not for the faint of heart. It is gambling if you are just throwing money left and right and choosing when. We're going to get into soon on the different styles of investing in stocks as well. There are two very different camps on how to invest in stocks. One is the active side, meaning, hey, I think that I can pick the winners and the losers. I think that I can, whether it's reading the charts or understanding the news or going through certain information, I find some nugget that I think is going to be a predictor of success or failure. And the flip side is passive investing, which is I can't predict the price of a stock. I can't predict whether it's going to go up and down in markets in general and what the timing is. So what I'm going to do is I'm going to use things like a passive or an indexed fund. We'll get into what mutual funds and ETFs are in the next couple of videos. But when I use that and I say, I'm going to buy and I'm going to hold for a long time, I'm not trying to pick which one is doing better or worse along the way. I'm going to take a much more backseat approach to investing. We'll get to whether which philosophy is right or wrong or indifferent and the differences between them in another video here soon. Remember to please like and subscribe these. We'll do a couple of quick updates along the way and make sure that you guys get notifications on all the videos. Again, please do comment below. Let us know what your questions, comments, concerns, anything that you want to know. We're hoping to kind of help provide because, again, I think the educated investor is a more successful investor. Have a great day.